What's up, everybody? This is Eric, and welcome to Fostering Finance. This is going to be my first video. I've been doing kind of giving financial advice for quite some time now, so I figure we try to put this together and see how things go. A lot of people I talk to have a lot of different conceptions of the market, so I kind of just wanted to start off my first video with just the stock market and exactly what a stock is, right? So let's say you have you build your company from the ground up, and you make bricks or whatever your company is into, and your company is a privately owned company by you, right? So as your company grows, you say to yourself, maybe you want to go public. When you may hear the terms IPO, this stands for initial public offering. This is when your company would essentially go public. All of these large companies, Apple, Google, Amazon, they're all public. So they're owned by the shareholders. So let me go into that. Um, you ask yourself, why would a company go public? Well, what public means is, some of the reasons why is you're able to raise capital. You're able to grow your company exponentially. So, with that influx of money, right? Um, Say you're running your business and you decide to go public, and you initially have your shares at whatever, $5, $10, and this is going to bring you millions of dollars of capital that you can grow your company way faster than you would, right? So now I want to talk about shares. So essentially, what this is your company, whether it's Amazon, Google, whatever, is broken up into a million pieces, sometimes a billion pieces, right? And these are called shares, right? So let's say if you each share is worth $1 and your company issues 1 million shares, your effective market cap is $1 million, right? So when people talk about market cap, this is your total market capitalization of what your company is worth, right? So basically, as the share price goes up, your investors, they like your company. They see that there's going to be growth in your company, so they invest in it, and your share price can effectively go up. Now, if your share price was $1 and it's people see, wow, this company is going to grow, I'm going to invest more money in there, and your share price is going to go up to maybe $2. And with that same issuance of shares at a million, your company is now worth 2 million, right? So now to get into kind of fundamentals to where, people ask, well, how do you really make money, right? Obviously the shares go up, you make money, but there's different kinds of stocks, right? So you have growth stocks, which is what most people kind of know, right? These are your more innovative companies, like, again, I keep using Apple and Amazon, and they're growth stocks, and they're going to use all that money that they're gaining, they're going to use it and reinvest it into the company and try to make it grow bigger and bigger and bigger, and therefore their price goes up, and this is how you're going to make profit, right? The other type of stock is a dividend kind of stock, right? So there's some companies that, of course, they want to grow, but they're not going to grow at an exponential rate like these tech companies and things like that. So picture a company like a electric company or a coal company, right? I like to use electric company because their grid can be in place and they make money. Of course, they're going to do minor infrastructure fixes, but they're pretty much their profits at the end of the year, they give it out to all the shareholders, right? So if they made $100 million profits, they're going to divide that over all the shareholders, and you could look at dividend stocks and see quarterly how much they'll give out. Okay, so enough about that. The next thing I wanted to talk about was actually the markets itself. So everybody, and this is kind of my first step that I talk about. Everybody, it scrolls across the news all day long, and I tell people that this is important, right? So when you see the Dow, you see CNN is talking about the Nasdaq, and they're talking about the S&P 500, and all of this kind of stuff. It seems kind of daunting, right? So that's why I want to break this down kind of easy, right? So we're already familiar with shares. You have an Apple share, Amazon share, whatever, right? So when they talk about the Dow, these are indexes, right? Or indices, if someone wants to say something. Um, the Dow, the Nasdaq, S&P 500 are the more common indexes that we go upon, right? So what is the Dow? So the Dow Jones Industrial Average is pretty much just 30 stocks. It's built with just 30 stocks. And they position these stocks, as you can see them down here, they're not just in one industry. They're kind of built all over, from innovation to fast food to banking to tech to oil. Um, Boeing and Caterpillar are in there. Well, mostly Caterpillar because that kind of shows like um, our building and stuff like that. But basically, what it does is it gives an overall picture of the economy in the United States, right? Now, the economy does not match the stock market, but it'll kind of give you a picture. Like if all of these companies are doing good, obviously there's a lot of spending, there's a lot of building, there's all of these companies are doing good. The Dow Jones is doing good. That gives us a kind of a picture of the economy. Um, uh, I I wouldn't necessarily reflect that on what's going on today because there's a lot of uncertainty and probably cover that in other videos, right? So I want to just quickly talk about the Dow. That's the Dow Jones Industrial Average. The S&P 500. I didn't even pull up a page for this because it's pretty simple. S&P 500 stands for Standard and Poor's Index 500. It's just some two dudes named Standard and Poor's, and they made this index called the S&P 500. All it is the top 500 companies in America. And if there's one that falls out, there's another one that goes in. It is very simple, you know. So that's why I want to explain it. So it may seem complicated, like you're saying these words that you haven't heard before, but it's pretty simple. Nasdaq. I'm going to move on to the Nasdaq. These are just tech stocks. So when you hear Nasdaq, you just think tech stocks. And I brought this list up here. It's easy to see. Microsoft, Amazon, Alphabet. Alphabet owns Google, right? Um, so I wanted to get that out of the way. And now that we're talking about these grouping of stocks, I wanted to now move on to like, okay, how am I going to invest into this? And I'm going to talk about how most people do. They like to buy stocks, right? So you buy a stock, it goes up, you make money, or it goes down, you lose money. Now, a kind of better way to allocate your assets, right, and reduce your risk, because everything with investing is like risk and reward. You don't want to have everything high risk, high reward. You kind of want to have a balanced mix in there, right? So I'm not sure all the individuals out there that are familiar with mutual funds or ETFs. Mutual funds is kind of like the older usage where It's just a bunch of different stocks, kind of like the Dow. It's just a bunch of different stocks in a basket, and that basket moves together. So if one goes down, one goes up, it doesn't affect the whole basket as much, right? Versus if you have Microsoft stock and it goes way down, you lose possibly everything. Whereas if you had a mutual fund or an ETF that had 50 stocks in it and one of them goes down and three of them go up, you're basically going to be in a safer position. So ETFs, basically an ETF is the same as a mutual fund. It's a basket of stocks and it is traded on the exchange, and that's where the name comes from. It's an exchange traded fund. So basically, I like to kind of have people in these options, which are smarter, less riskier, so you can be diversified, right? You can have mutual funds, you can have ETFs, and obviously, when you're talking about asset allocation, people say stocks and bonds. You hear stocks and bonds. So I kind of wanted to go over that too, right? So a bond is nothing simpler than just, like it says here, a fixed income instrument, and is basically one of the safest investments, right? Because it's just a loan. It's just a loan from the government or from the state. They issue you these bond coupons and you can buy them, and in 10 years they're worth a little bit more or whatever. So they're really safe, right? Low risk, low reward though. You're not going to make that much money on them, right? So if you're young, how do you want to allocate your assets, right? Now, with the advent of computers, everything is all automated right now. So you should be able to put your money in these funds that will work for you. And what I mean by this is when you're young, 25, 35, you want to have pretty much all of your asset allocations in stocks. And when I say stocks, I mean in these ETFs, not in individual stocks. You should be probably 80%, 90% in these stocks, and probably 10, 20% in bonds. Why is this? Well, because you're not going to retire for 30 to 40 years. So you don't really care what the stock market does. You're buying into this every month or every couple weeks, whether you have a TSP or 401k or IRA, you keep buying into this. So you don't care if the market goes up or down. Actually, you want it to go down. And you want to leave that money in there for that time, right? And you just keep buying and buying and building, right? So let's just say now you're, 55, 65, you're getting closer to retirement, right? All that money that's kind of saved up in there, well, what if the market decides to crash? You don't want to have all your money in stocks because then all your money's gone. So this is why as you kind of get older and as you get closer to retirement, you should be changing your allocation. And as you get closer to the retirement age, you should be probably 80 to 90% in bonds. Well, that's a bit heavy. Probably 80% in bonds and, 10, 20% in stocks. So if it goes down, you don't lose as much and you, for all your life what you saved into. Now, all of these things, like I said, should be happening automatically now. Every financial organization has these instruments that they call life path funds, 2040, 2050, whatever your target date is, and they'll adjust your allocation every year or so to kind of match up to when you're going to retire. So this is a far improvement from 50 years ago when the market would crash and people would lose their retirements and things like that. So on that note of talking about asset allocation, I hope many of you have heard, you have cryptocurrencies, you have digital assets, and this is going to start coming about percentage and what percentage of digital assets you should have. So I think I'm going to end this here. I'm going to definitely cover those in a different video. I'm going to end with that I'm not a financial advisor. This is for entertainment purposes only. I hope that you guys like the content in this video. And I'll have another one shortly.